Hi everyone, this is Prashad Parthiban. Today I'm going to cover federal crop insurance, and this is going to be an introduction video, and in my next video I will cover the life cycle of federal crop insurance. So by definition, crop insurance is nothing but insurance coverage for farmers. So when they have crops in their land, if there is a fire or theft or some natural occurring events that destroys their agricultural land and especially crops, we need required coverage. That is the reason why our federal government have come up with this plan, federal crop insurance, otherwise called as multi-peril crop insurance, which means we know what do you mean by peril. It's a cause of loss. When you say multiple peril, which means multiple cause of loss, it could be fire, drought, insects, etc., etc. So whenever you see a plan which says multi-peril crop insurance, it is being subsidized by Federal Crop Insurance Corporation, which is from federal government, and regulated by Risk Management Agency. So they are the one who are going to say, for this particular coverage, for this particular amount of acres of land, this is a rate that you have to provide. And the way federal crop insurance works is, they have 14 approved insurance provider, it's not like any insurance provider can give coverage. They have 14 approved insurance providers. They are the only insurance companies who can give this federal crop insurance. And the rates are going to be common. There's not going to be different rate from one carrier to another carrier. As long as you know which carrier provides good service, you can choose one that you like. Now, we talked about crop insurance. We talked about what is the role of Federal Crop Insurance Corporation and Risk Management Agency. Now, at a high level, there are multiple plans, but the most kind of popular plans are yield insurance as well as revenue insurance. At a high level, yield insurance gives protection. Say if I have a crop and it did not give me an expected yield. Say for a particular acre, I am expecting 100 bushels. Bushels are a kind of old terminology. So what they do is they have a big can, right, and they put grains like apple, right. So what they do is, for a particular period of time, if you take 3 months, how much is the expected bushel? How much is the expected crop? Say they say 10 bushel for the particular quarter. I should have been harvesting like 10 bushels of apples, right? Like each bushel can be a kind of can, right? So that's a kind of actual production history, right? Now, what I am expecting is, for the next quarter, next 3 months also, I expect the same kind of production. If that does not happen, then we get insurance coverage from the insurance provider. Let's see an example, you'll get an understanding. So when it comes to yield insurance, right? So what happened is, a particular farmer have said, for the past 3 years, I always harvest 180 bushels per acre, right? So bushels, basically it's like a word terminology, which is equivalent to kilos or pounds, right? So they say for a particular 4 years, they used to get 180 bushels per acre. Now, the insurance coverage goes from 55% to 85%, which means the farmers can elect what is the total percentage that they want to insure for. The remaining 20% is going to be like a deductible. They have to put some money from their end, right? So in this example, farmers have selected 80%, which is nothing but 144 bushels per acre. Now the actual yield, for some reason, right, like due to some unavoidable reasons, they got only 120 bushels per acre, which means there is a difference between 24 bushels, right? Now what happens is, in case of yield insurance, there is a separate committee which determines what is the projected price for each bushel, right? So in this case, they determined it as $4 per bushel. So because of the fact we have lost 24 bushels from the actual yield, we are multiplying 24 into projected price, which is the $96 is the actual claim payment in this example. So if you see this example, we are talking only about the yield. We expected a yield of 180 bushel, whereas we got only we expected a 180 bushel and I got insurance only for 80%, so which means 144. But the actual yield was only 120. So there's a difference between 24 bushels. For the 24 bushels, I'm getting a payment of $4 per acre, which comes to $96 payment. This is a high level example. Now there is another plan called revenue plan. This is like a special plan, right? It covers the yield insurance, plus it also covers the revenue. When I say revenue, let's see an example, right? This is the total number of yield. What happens if the projected price, in this case, got decreased? Say you have a projected price of $4 per bushel. Now when you harvest the crops, they come, like whatever the committee that determines that at that point in time it is only 3.50 per bushel, right? That means farmers is losing 50 cents per bushel. In that case, the claim payment, if you have a revenue plan, is they will see the difference, which is nothing but 0.5 cents, right? And then they will multiply the overall coverage amount, in this case 144 bushel. So they will pay you additional $72 because there is a revenue loss here, right? Apart from yield loss, there is a revenue loss. So when you go with this coverage, you will get additional $72, and again, premium will be a little bit more with respect to revenue plan. Now, it's not only when the harvest price decreases, sometimes your projected price could be $4. The moment you harvest, it could be 4.50, right? So the way it works is, whatever is highest, in this case, because initially you projected $4, now the committee have projected the harvest price as 4.50, so they have to take the highest of this two. In this case, the highest of this two is 4.50. Because initially the payment is determined based on $4, now the difference of 0.5 has to be taken into account, which gets an additional $12 payment. So in short, if there is a revenue loss due to the increase in price, then you can use the revenue plan to get the additional revenues. At the same time, if there is a yield loss, you can use yield insurance. So revenue insurance covers both yield loss as well as revenue loss. I hope you like my training videos. If you like my training videos, please do subscribe to my YouTube channel. Have a great day. Bye-bye.